We've had numerous strategists take down their expectations, take down their calls in the U.S. markets. Brian Belsky was with us the other day, and he had a 6,700 target on the S&P 500, which he has now revised. Excuse me. I have the note in front of me, but better than that, Brian Belsky joins us now on the phone of BMO Capital Markets, of course. Brian, it's great to have you on. These markets and the speed and the severity, you say, of the drawdown has surprised you, and this is the result, correct?
It is, and thank you so much for having us, and that's why we started off our note here today with that very same sentence. As we kind of watched this attempt to kind of settle out, Scott, we really wanted to look at historical patterns in terms of what happens if we hit a bear market. And as we said on Monday, and as we said in our piece that we published on Sunday, and it almost doesn't matter whether or not it's a 10% correction or 20% correction. Historically, when you go back to 1950, we have these violent rebounds. But in the midst of that, we actually also have to really be very thoughtful in terms of how we're looking at the fundamental conditions of stocks, because our mantra has always been stocks lead earnings, which lead the economy. And there's been a lot of rhetoric out there that the market can't possibly start going up until or rebound until earnings bottom. Well, again, our work and our research that we spent the last 3 days kind of working through is that earnings bottom 9 months into any kind of bear market. Now, again, we're not calling for a bear market. We need to be thoughtful in terms of this downside, and we need to also be prescient in terms of what's going to get us there. So under the premise, again, of stocks lead earnings, which lead the economy, we think that it's a very good chance that earnings kind of bottom 6 to 9 months from now, and if indeed this is the bottom. And I think, again, anytime you try to make very short-term calls, it's dangerous. But we still believe that if and when we get a rebound, that rebound will be violent, it'll be strong, and U.S. markets are going to lead the rest of the world.
Aren't we already in a bear market? I mean, it's almost irrelevant at this point as to looking at a textbook to decide what we are or what we're not. The fact of the matter is that there are too many stocks within the S&P 500 that are and have been in a bear market.
I think that's a valid point, and thank you for making it. Again, we want to go look at history. History is not necessarily predictive of future events, but we also need a guidepost. And as I said on Monday, and we've also lived by this rule of it's never different this time. And we do think the market obviously has been driven by these headline-driven almost hourly changes in what's happening out of Washington. And we kind of put that to the side and kind of look at how much stocks have gone down and where we've been stating really, Scott, for the last couple of years in terms of this notion of don't be so concentrated with respect to particular sectors and positions. We want you to own a little bit of everything in the U.S. And that's why our theme of underweighting the Mag 7 in those sectors that represent the Mag 7, namely technology, consumer discretionary, and communication services, and owning the other stocks in those areas in terms of overweighting them in U.S. portfolios. In the money that we run, we have the good fortune of running in both Canada and the United States, that has helped our portfolios outperform during this downturn. And we do believe that that's going to position portfolios accordingly across most disciplines, whether or not you're value, dividend growth, core, or even more defensive property. So we're very, very comfortable with the $6,100 number, and we're comfortable with the $250 earnings number for the S&P, and that's where we are right now on a trailing 12-month basis.
All right. I appreciate you calling in and bringing our viewers up to the minute on what you're thinking and doing. Brian Belsky of BMO. We'll see you soon. I have no doubt about that.
Scott, can I make a few very quick points?
Real quick, because I want to get Kerry in.
Yeah, a few quick points. Number one, China selling bond treasuries is not a foreign thought. In 2019, they were at $1.3 trillion. Their holdings now are $760 billion. And keep in mind, we kept issuing. So less important, number one. Japan owns more than they do. Number two, you can't put aside, as Brian suggests, the tweets and all that, because that is the problem. That's what we're seeing. So this is not a single event like when Buffett came in during the financial crisis and bought Goldman, and when the Fed injected massive liquidity. This uncertainty is going to survive for the entire presidency, and that's why CEOs are uncomfortable. Third and final point, I was at a conference in Vegas last 2 days. DealMax, 2,000 deal makers, bankers, private equity firms, large LPs, everything is frozen. And the fact that credit spreads haven't blown out doesn't mean they won't. In fact, they will widen.
Sure.